If you own a home, you may have heard that you can use your home equity. It can sound simple, but before you move forward, it's important to understand what that really means. Home equity is the difference between what your home is worth and what you owe against it. If your home value has increased, your mortgage balance has gone down, or both, you may have equity available. But home equity is not just cash from the house, it's borrowed money secured by your home. That doesn't make it bad, it just means the decision should be made carefully. The best place to start is your goal. Are you trying to consolidate debt, pay for home improvements, cover a major expense, create financial breathing room, keep a low first mortgage rate while still accessing equity? Different goals can point to different loan options. One option is a cash out refinance that replaces your current first mortgage with a new mortgage. The new loan pays off the existing mortgage, and if there's enough available equity after costs and payoffs, you receive cash back. That can make sense when replacing the current mortgage is part of the goal. Another option is a home equity second mortgage. That's a separate loan secured by your home. It doesn't replace your existing first mortgage, which can be beneficial if your current mortgage has a low rate or favorable terms you want to keep. A third option is a home equity line of credit. A HELOC gives you a line of credit secured by your home so you can draw funds as needed under the terms of the line. That flexibility can be helpful, especially for ongoing or uncertain expenses, but it also requires discipline. Before choosing any option, look closely at the payment impact. Using equity can change your monthly payment, your total debt, or both. A debt consolidation strategy may reduce your total monthly payments, even if the mortgage related payment increases. A home improvement project may add a payment, but it may also protect or improve the value of your home. The question is not just, can I get the money? A better question is, does this improve my financial situation? You also need to understand how lenders review home equity requests. Having equity is important, but equity is only one part of the review. Lenders also look at income, debts, credit history, property value, existing liens, occupancy, loan purpose, and the loan program requirements. In Texas, there is also an important limit for home equity loans on a primary residence. The new home equity loan, when added to any other liens against the home, cannot exceed 80% of the home's value. That means you cannot borrow every dollar of equity. That 80% limit makes the property review especially important. The lender has to confirm the value being used for the loan, along with the existing liens, title, taxes, insurance, and other property details that affect the final loan structure. If the value comes in lower than expected, the amount of equity you can access may be lower than you wanted. There are some other common surprises. Closing costs still exist, even if they're included in the new loan amount. A no cost loan often means the costs are being financed, not that they disappeared. Timing matters too. Home equity and refinance options involve disclosures, appraisals, title work, waiting periods, and funding rules. If you need funds by a specific date, talk about timing early. The big picture is this: using home equity can be a smart financial tool, but it should start with the goal. Understand what you're trying to accomplish. Estimate the available equity. Review the payment impact. Compare the possible options. Then ask whether the loan helps you make a smart financial decision. You don't need to know every detail before asking questions. At Texas Lone Star Lending, we believe it should be okay to ask questions. That's why we're your loan educator.